Hi everyone, I'm Andy. I've been an international tax advisor since 2014, a chartered accountant since 2018, and on this channel I help business owners navigate the complex world of international tax. In today's video, I'm going to be walking you through a W-8BEN-E form for a UK limited company. So if you're a UK limited company owner who has some dealings with the US, then you may have been asked to fill out a W-8BEN-E form. It could be that you've got US clients, or perhaps use a US-based platform such as Amazon, eBay, Upwork, or perhaps affiliate marketing networks like Amazon Associates or Google AdSense, or you could just have investments with US brokerages. So what is this? Well, a W-8BEN-E is a form used by foreign entities such as a UK limited company who receive US sourced income. The purpose of the form is to confirm that they are in fact a non-US entity for tax reasons. This is because under US tax law, when a US company makes payments to a foreign entity from US sourced income, it needs to withhold 30% of that payment and hand that over to the IRS. This 30% is known as the statutory rate of withholding tax. However, thankfully the 30% withholding tax does not apply to all foreign entities, because the US has what's known as double tax treaties, which are basically agreements they have with other countries to reduce or eliminate withholding taxes between those countries. In the case of the UK, the US has a double tax treaty which reduces withholding taxes, sometimes to zero, other times to lower rates such as 5 or 15%. It depends on what type of income. So what happens if you don't file? Well, the US entity might be required to withhold taxes at the default 30% rate on payments made to you. So your US client might only send you $70 of every $100 that you invoice them for. But under the terms of the US-UK double tax treaty, you could be eligible for 0% withholding taxes, meaning you could cost yourself a lot of unnecessary US tax if you don't get this right. So this is what the W-8BEN-E form looks like. You might have received one of these from your client, or perhaps one of the platforms that you might use. And from the outset, it looks quite intimidating. There's 8 pages and there's a lot of legal and tax jargon in there. So yeah, from the outset, it doesn't look like a very nice form to fill in. But as a UK limited company, in most cases, the majority of the form is non-applicable, and so I'll just walk you through, a kind of typical case here, and we'll get started. So this is basically a form which I've done for demonstration purposes, and starting out, we'll look at part 1. So the name of the organisation, I've just put in my UK limited company name, and country of incorporation, so of course that's the UK. And number 3, we're just going to put in not applicable, because as a UK limited company, we're not a disregarded entity. That's a totally different type of entity that we don't need to worry about here. So chapter 3 status in number 4. Here we click corporation, because a limited company in the UK is basically viewed as a corporation from a US perspective. So every time we've got a UK limited company, we can just use this section. For number 5, chapter 4 status. So here we're going to be using active NFFE. So what this means is non-financial foreign entity. And basically that just means you're a company, but you're not a financial entity such as a bank or an investment company or insurance company. Nor are you publicly traded. So in almost all cases, you're going to be picking active NFFE. The next part is just the address, and again, fairly simple. Permanent residence address, you just use the address which is your company address on Company's House, and the mailing address. If it's different, you can also put that there. If not, you just leave that blank. So the next part is the identification of the beneficial owner. So in this section, some people get confused. They think that they might need a US tax identification number. But actually, if you have a UK limited company, you already actually have a foreign TIN, which is basically a foreign tax identifying number. And this is your UK UTR, your unique tax reference, which you use for your corporation tax filing purposes. So just look at any letter you've got from HMRC, and you'll usually see that in the top right corner of the letter. And so you just put in your 10-digit unique taxpayer reference, and that's you covered from the foreign TIN aspect. So part 2 we can ignore. As we said earlier, this is a disregarded entity section which does not apply here. So the next part is part 3, the claim of tax treaty benefits, and this is when it can start to get quite technical and complicated. So 14A, we can tick this box to say that the beneficial owner is the United Kingdom, so that part's pretty straightforward. But B is when it gets a little bit more complicated. So basically B is trying to confirm that you're not just using the benefits of the double tax treaty to gain a tax advantage. You know, there's genuine substance behind, you know, why you have a UK limited company, because there is the existence of people out there who may be what's called treaty shopping. So they shop around for the best tax treaties and the best benefits, and so they perhaps incorporate a company purely for that benefit, but they have no other real substance in that country. So in this section, we'll tick this to certify in B, but then we have to pick one of these options if we're a UK limited company. So the first one is the most commonly picked one that I've seen. So this basically applies when a UK resident owns more than half of the company. And so in that case, we can basically just tick this and say the company meets the ownership test, it's owned by UK residents, and that's it basically. The second one typically wouldn't apply because it tends to just apply to EU related companies these days, and anyone involved potentially in Mexico and Canada. So for UK purposes, we don't see this used very often anymore. But potentially the third one could also apply, and this is also where the company has more of a presence in the UK than it does in the US. So let's say, you know, you've got a trading company that's doing business in the US, but it's also doing, you know, substantial business in the UK and perhaps any other countries. Basically, as long as the activities are more substantial outside of the US than they are inside of the US, then you can tick this box. But either way, you do have to choose one of them. In most cases, it's a simple case of just using this top one based on the ownership, and that'll be it. So the next part, number 15, this is when it can get a little bit technical, and you do have to refer to the double tax treaty. So, as I said earlier, the rate of withholding tax which you're going to get on your US sourced income is going to be dependent on what type of income you are getting from the US. And in order to find out, you know, what rates apply to what income, you do have to look at the double tax treaty. So just to illustrate for you, and I will link the double tax treaty, this is what it looks like. This is the front page, and this is your content. So you've got 30 articles, and they all contain different bits of information about the agreements between the UK and the US, what potential withholding taxes may apply, and other aspects such as what makes you a permanent resident from a tax perspective of one state or another, and lots of other, you know, important information that basically that both countries have agreed to from a tax perspective. But, you know, going through these in detail is again quite overwhelming. Let's say, for example, you've earned dividends from the US. You'd click on this and you'd find the article which contains, you know, some technical information about dividends. But yeah, generally speaking, you know, again, reading through this can be quite complicated and technical. So I have summarised here the main forms of income that people do receive from the US and which withholding tax rates will apply. So if you just look here, the top one is the business profits article, and that's Article 7 in the treaty. And so business profits is extremely wide, but generally means the profits from any trading business. So for example, you might have an e-commerce business selling goods into the States. You might have a content creation business, you sell digital products. But basically, in the vast majority of cases, you've got a UK limited company that's trading and making profits in the US. This is going to be the article that you'll refer to when it comes to the W-8BEN-E form. And so, let's just say that's the scenario that I'm looking at. What I would do is I would reference this Article 7, Paragraph 1. I would reference the 0% rate, and I would reference the business profits article. And so I go back in here, and this is what I've done here. 7, Paragraph 1, business profits, and the 0% withholding tax rate, which we are entitled to under the treaty. Now finally, you will also have to put this sentence in to confirm that you don't have a permanent establishment or you're not carrying out business in the US. And this is another important point, just to double confirm that there are no US taxes due on the income. And so regardless of what article you're referring to, regardless of what type of income you're referring to, this part will always stay fixed. So if we go back into this, I'll just explain the other types of income. So we've got interest. So this is when you may have earned interest from the US. You might have some investments that pay you interest, and so here you also get 0% withholding taxes, and you just refer to Article 11, Paragraph 1 for that. The next one is when you have dividends paid by US corporations. So you don't get 0% here. The normal 30% rate has only been reduced to 15% as opposed to 0. And this is where you have dividends from a US corporation which you don't have significant ownership of. So that generally means you might have investments in US companies that are listed in the stock market. You might have just a few shares in them and you're getting paid those dividends. And as a result, any of those payments will be withheld at 15% from a US tax perspective. The next one is also dividends, but this is when you do have significant ownership, and the ownership generally requires that you have 10% of the rights in the company. And so when you have a US corporation, you own 10% of more of it, you can actually claim this part of the tax treaty, and so you only get to be taxed at 5%. So that's obviously much more beneficial than when you're not a significant owner of the company. The next two, these are quite rare, but if you have some pensions income, annuities, social security coming from the US, then again you get 0% rates of withholding, and you just refer to these articles. And then finally, this can be more common, especially in tech companies, but when you have royalties from the US, you also get to claim a 0% tax withholding. You can refer to this article and refer to royalties income. And so we go back into the W-8BEN-E form. Again, the only things that would change is refer to the article in the paragraph, refer to the type of income that we're discussing, and whatever rate is in there. And so next we can ignore the rest of these. These are all non-applicable. These all refer to different types of entities that we didn't choose at the start. And the next one that we will have to worry about is, we'll just keep going down, this one, 39. So as an active NFFE, we just certify that all of these apply. So basically we're certifying that we're not a financial institution. The majority of our income is not passive income, and also that less than 50% of the assets held are for the production of passive income. So again, that's really what the active is referring to here. It's it's a trading company. It's trading a normal course of business. It's perhaps selling products, services, and it's not passive from that aspect. So again, the rest of it we can ignore until the certification at the end. And here we can just certify that, you know, this is all correct and true. We certify that we have the capacity to sign and sign on behalf of the entity. So we'll sign our name here, print our name here, and then today's date. And that's us done. So hopefully that was a useful run through. As you can see, the form does look pretty complicated and intimidating at times, but as a UK limited company owner, thankfully, you know, we usually don't have to look at too many of the sections. So it's really just about confirming, you know, your type of income and just cross-referencing with the double tax treaty to, you know, make sure that the right rates have been inputted. But if you've got any comments or questions or anything you want me to expand on in this, just give me a shout in the comments below. Cheers.